In this video that blew up, I said that if you have 20 years or more to retirement and you are in low risk investments, you are losing a lot of money. Now, what's the difference between a low risk and a high risk investment? Technically, a low risk investment is something that doesn't fluctuate a lot in value. So think like GICs or CDs or bonds. Now, these are considered low risk because you know what you're going to get. Higher risk investment is technically considered like a stock. The values fluctuate a lot every day, meaning some days you make money, some days you lose money, and in the short term, we don't know what we're going to get. That said, risk is relative, and your tolerance to risk depends on your current financial situation, your goal, and your timeline to that goal. Now, higher risk investments like stocks have the ability to give you a higher return or to make you more money. And studies show that when buying stocks, like this study by Vanguard, those risky investments become much less risky over time. So if you invested in stocks for only 1 year, your chance of losing money would be 1 in 4. But if you invest for 20 years or more, that drops to 0 based on historical information. Now, what makes me so angry is when people go in and they talk to financial advisors or they talk to the guy at the bank and they ask if they're comfortable taking on high risk investments. A lot of times they are not explaining to you that if you invest for a longer period of time, that risk is relative. So instead of educating their clients and helping them get into the right portfolio with the right asset allocation that is going to make them the most money, they just put them into something mid-risk or low risk and call it a day. Because they're still making their fee regardless. Actually, I had a student, she was in her early 20s and she came to me and she's like, Nicole, I'm so proud. I've been investing. I'm in mutual funds. When I looked at her portfolio, not only was she paying an almost 3% fee, but she was in mostly bonds. And this was for retirement saving. And her expected growth, meaning the money that she could have made because she was in a lower risk portfolio with a lower return, wasn't much higher than the fee was. She would have been better off just putting her money in a high yield savings account. Now, had this girl never educated herself, she could have gone her entire life thinking she was doing the right thing, investing, and then got to retirement and realized she didn't have enough money to retire, and that she missed out on literally hundreds of thousands of dollars of free money. You are decades away from retirement. No, you should not be in low risk or mid risk investments. And if you are losing a lot of money. Also, if you're paying for mutual funds or high fees for an advisor, you are losing so much money too.